Hello everyone. Today we are going to discuss our best investment view fund called the Momentum Flexible Income Fund. What is the building blocks of this fund? How do we think should a flexible income fund be constructed? We're going to firstly look at all the different building blocks. How do we get there? And towards the latter part of the presentation, we're going to actually look at the fund and we say, well, are we doing what we're saying and saying what we're doing? So let's get into it. Firstly, what's happening in the world? The US matters. Why? Because the Fed sets the global interest rates. So when they move interest rates, the SARB also has to move interest rates. Think about it. A year or two ago, when we were coming out of COVID, interest rates in the US were 0.25%. Now we're up at 5.25%. Interest rates in South Africa, the repo rate was 3.75. Now we're at 8.25%. It matters. So every time the Fed moves the interest rates and bond yields move, the South African bond yield should also move. Think about it. 2 years ago, the US bond yield was probably around 30 basis points. Now we're up at 5%. The South African 10-year rate, closer to 9%. Now we're up closer to 12%. It shows you when the globe moves, we have to move. We have to anticipate it. What does it mean? What does it mean for valuation? What happens in the US affects Europe, the UK, all the continents. Being a global economy, it means South Africa has to follow. Right, so now we know, building block 1, US, if it moves, we will have to follow. But it's not an all fall down scenario, because we think that corporates in the US are actually very strong. Think about it, we've had this massive move in interest rates. Now typically what you would see when interest rates move a lot, US corporates start to default. What are we seeing? The US corporate balance sheets are actually in a very, very good condition. Very low defaults. Very low non-performing loans in the banking sector. What does it mean? Low spreads. So when this graph moves up, it means a lot of risk in the market. Lots of defaults in the US economy, which is negative for emerging markets. What are we seeing at the moment? Low defaults. It's good for emerging markets. Credits look good. So yes, we want to be investors in US credits. We think there's a good opportunity there. Building block 2 for the flexible income fund. US corporate spreads look very attractive at the moment. So what has happened to developed market bonds? Well, as we said, they all moved higher. Remember we said the US moved from 30 basis points up to 5%. We've seen very similar moves. European bonds, UK bonds, Japanese bonds, yes, albeit at a lower level, but the trend is the same. That's why we've seen emerging market bonds move as well. What does it say to us? Bonds are cheap. Yes, they were cheap probably 2 years ago, but now they're a lot cheaper. And we think, yes, we think there's a good opportunity for a flexible fund to be exposed to various duration bonds across the globe. So that's what's happened globally. So let's look what's happened in domestic markets. Firstly, money markets. We all know that the SARB has hiked rates all the way up to 8.25%. What does it mean? It actually means for the first time in about 3 years, there's very attractive real yields available in South Africa. Think about where inflation is, around 5.5%, and we can invest 1 year NCDs around 9%. Wow, 3.5% real in cash, that's really your safest asset class. That's a big tick for assets in our flexible income fund. So cash, definitely a winner at the moment. What's the market pricing for interest rates? It says, well, interest rates in South Africa is probably at the top at 8.25%. Yes, there may be a probability that they could still hike interest rates towards the latter part of this year, may or may not. But what's more important is that the market is actually starting to price for interest rate cuts from the middle of next year. The FRA market says, look, the SARB has hiked rates all the way. It's probably going to be steady for the next 6 months or so. And when we get closer to the middle of 2024, well, let's hold on, because then the SARB might actually cut rates, which will be a good thing for our assets, good for the economy, good for various different asset classes in South Africa. We're probably going to see a very similar trajectory from the Fed, that the Fed will probably go on hold as well and also start cutting rates somewhere in the middle of 2024. So watch out. I think there's good opportunities in South African fixed income in the next 6 months. If we move to the credit market, what's happening there? And we're talking about the listed, rated market in South Africa. Well, we've seen about 130 billion of issuance in this market. Quite a lot. It's basically been dominated by the banking sector. So the banks in South Africa really want to use the opportunity to lever their balance sheets because they think there's opportunities. They issue a lot of debt at the moment. Not always at attractive levels, but we'll get into that. We've seen a little bit of corporate action in South Africa where for years now we've seen industrials and mines and retailers not really being that active in the South African market. Over the last 6 months or more, we've really seen a lot of these corporates coming back into the South African market, issuing term debt, levering up the balance sheets. But it doesn't concern us because we think that the overall balance sheet of corporate South Africa looks very attractive. So another tick for that flexible income fund. We think corporate credit looks attractive to us. Yes, when we get into the pricing now, it's not that attractive. But remember, as a value asset manager, it's always our mission to find that diamond between all the rocks. We dig through those rocks to find that diamond. Yes, it's probably not that easy to find. But what we are saying is that the market is actually pricing spreads very tightly, or the prices are actually high of South African corporate credit. But what's important in that statement is that the quality is also high. So we think that the probability of default of South African corporates are actually very low. It means when we buy a Bidvest or a Sasol into our portfolios, yes, the pricing might not be that great, but the quality is very high. The probability of default is actually very low. So yes, another tick for our flexible fund. Do we want to own corporate credit? For sure, at the right price. So as we go along, you can clearly see that there's a lot of ticks for a lot of asset classes that's making a claim to have an allocation in our flexible fund. Okay, so now we talked around the short-dated asset classes, but what's happened in duration assets? Well, let's have a look. Bonds, wow, it's been a rough ride up. Remember we said the US 10-year all the way from around 30 basis points up to 5%. South African bond yields, let's say sub 8% over the last 3 years, all the way up to 12%. It's been a very, very rocky ride. But now, if you think about it, inflation is 5.5%. Next year, probably closer to 5%. 12% yields. When you talk around 6.5% real yields in government bonds above inflation, wow, guys, that's a big tick saying that this is an asset class that's making a play for our flexible income fund. It should be there. Let's have a look. This is the South African yield curve, right? So now we say, well, what does that term structure of South African long-dated rates look like? Very, very steep, right? It means the market is pricing for a lot of negative news in the South African yield curve. So yes, we know about Eskom. We know about Transnet. I think the news is full of this stories with the Minister of Finance. What is he going to do in the various budgets coming, right? There is a fiscal issue. That's fine. But to us, we say, well, what is already in the price? Yes, we know about these negative things, but the curve prices for it. And we think a lot of the negative news around the South African fiscal position has already been priced. Because think about it, at inflation plus 7, it means there's a big risk premium already in the South African market. So we believe that South African bonds really has a place in that flexible income fund. Why? Because it looks so attractive on a nominal and on a real basis. Talking about real yields. Where's real yields in South Africa? Well, let's have a look. Inflation-linked bonds. Now remember, inflation-linked bonds is that protection instrument in fixed income. When inflation moves up, it protects you. What has happened? Well, those yields have also moved up. We think there's great real yields in South Africa. Why? Think about it. The 10-year inflation bond in South Africa is sitting at 5% real. We're talking about equity type returns in a fixed income asset class with a SARB guarantee. Because if inflation moves out, you know, the SARB is gonna hike rates. So you basically get an implicit guarantee. So if we look what that curve looks like, also very steep, very elevated, 5% real yields on 10 years. I think that's an asset class that should be in our flexible income fund. So once again, you can clearly see when we go through all these different asset classes, lots of these assets actually make a play to be in our fund. It's becoming actually quite difficult for us to say, well, all these asset classes look so attractive, where are we actually going to allocate assets? Well, that's always the fun and the art of fund management. And that's what we're trying to do for our clients, because think about it, when we speak to clients, what do you always ask me? You always say, Ian, should I be in cash? Should I be in inflation bonds? Should I be in nominal bonds? Should I go offshore? Well, we think the flexible income fund is that solution where we actually as a team decide where we think the best opportunities should be for you as our investors. So let's go and have a look at that fund. So what is a flexible income fund? Well, it's our team's, the fixed income team's best investment view across the 6 yield curves that we manage assets for you as our investors. Yes, it has prudential limits, so we can go offshore. We can actually get into that offshore credit. It looks attractive to us. Yes, we can go into property up to 10%, and you will go, property, what are you talking about? Well, we think there's 1 or 2 diamonds in property. We think there's opportunity. Not everything in the property sector is rocks. There's 1 or 2 diamonds. There's a low duration risk profile to it. So yes, it's not a money market fund, but it's also not a bond fund. But we would say to you, if you invest in a flexible income fund, please, it's not a parking bay for cash. It's not a money market fund. Please, we think that you should be there for at least 2 to 3 years so you can actually run through a full interest rate cycle. What we don't want to do, and what we've seen in quite a few of these funds, is actually active foreign exchange risk. So be it. We've taken a decision in our team to say, we will take interest rate risk, duration risk, credit risk in our portfolio, but not FX risk. So all our offshore FX exposures are hedged. So we're not taking rand risk in our portfolio. We believe this is not the type of portfolio that should take foreign exchange risks. Right, now we've talked around it. What does that portfolio actually look like? Right, we said to you, cash looks attractive, so you'll see a cash portion there. Remember, cash is fighting power. We always want to have cash in the portfolio, so when markets sell off, we can actually apply capital. You're going to see a lot of credit there. Local credit as well as offshore credit. Why? We said to you, lots of safety. There are very interesting spreads, yields in the credit market. Nominal bonds. Why? Because we cannot ignore the 5, 6, 7% real yields of nominal bonds. You're going to see inflation bonds. Once again, you say, why? Because inflation is falling. I'd say yes, but that's why the real yields are very high. Remember, when inflation falls, real yields rise, and we say, well, you know, at the 10-year point, when you get 5% real yields, we cannot ignore that. We've got to have some inflation bonds in our portfolio. Property. We talked around properties, but we're not going to buy all properties. We are selectively going to buy property stocks and REITs where we say, well, look, these guys have taken a proper revaluation of the valuation on their properties. Expectations are low. Prices are low. We think there's a good opportunity in property. And if the SARB starts cutting rates, this will be an asset class that really benefits from a lower interest rate environment in 2024. When we move to where we're exposed on the duration side, we would say, well, look, this is an income fund. It's not a bond fund. So you'd probably find that the bulk of our exposure duration-wise sits somewhere between the 1 to 3 year, 3 to 7 year parts of the bucket. Yes, we do have a little bit of 7 to 12 years. Why? Because we cannot ignore the 13% yield that we are finding in that part of the curve. We understand that there's a risk, but we think we are compensated for that risk. So yes, very much centered towards what we call the belly or the middle of the curve. Not a bond fund, not a money market fund, but somewhere in the middle, and also delivering a high level of income for our investors over that 2 to 3 year investment horizon. So looking at the fund, what can we expect over the next year or more from these various asset classes? Right, so we said inflation probably going to be around 5% next year and 4.5% in 2025. So Let's firstly look at cash. So we said cash will probably give us around 8.5 to 9% over the next year, maybe a little bit lower because the SARB will cut rates next year. Still very attractive in that front end, but we think there's other opportunities as well. Secondly is credit. So you're probably going to get 9 to 9.5. So also another tick for that flexible income fund. What does the duration asset classes give us? So we talked around the 5% real yields, but remember, real yield does not equate to total return. From a total returns perspective, we probably say around, call it 8 to 9, 9.5%. So very good real yields expected from inflation bonds. And then the one that is a little bit of a lightning rod is bonds. If things should go horribly wrong in South Africa, you're probably going to have at the single-digit returns. But we think there's such a lot of negative news already priced in the curve. We think low double-digit returns from nominal bonds is very achievable in South Africa because of where the curve is. So you can clearly see on those 4 asset classes alone, we should have an allocation in each of them in our flexible income fund. And that's exactly what we did. Right. So what could happen that makes us change this view? What are the good things and the bad things? And it's not all bad in South Africa. So what are the monsters under the bed that concerns us that could really derail our views? Firstly, the fiscal situation is very dire in South Africa. We need the Minister of Finance to come out and tell us how he's going to fix this fiscal issue over the next 2 to 3 years. It's quite important. There is a problem with tax collection because we know that the commodity cycle is not helping our minds. There's not enough taxes on the corporate side. Remember that yield curves are inverted in developed markets. So in the US, the 2-year is much higher than the 30-year, for example. We actually need the Fed, the BOJ, the ECB to cut rates because that will support emerging market yields again. We know that load shedding will probably have to come to an end. And lastly, we know that there will have to be some sort of bailout plan for SOEs and our metros to try and help this fiscal situation. Yes, we know about this. It sits in the press every day, but we think it is priced in the market. So in the end, we say, well, we think our flexible income fund is really that flagship fund where it really sits in the middle of these yield curves. A lot of the risks are priced, but there's very high real yields available for us. Given all these factors, we believe the flexible income fund is correctly positioned to deliver high nominal and real returns over the next 3 years. It is our best investment view fund. You're going to get the best view from our team over the next 3 years, and we think it's a good place to be invested in fixed income. Thank you.